I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Pick and choose your own best-of-breed insurtech and data providers with Advantage Go's ecosystem. Today's guest runs a business that this year is set to quadruple in size since the first time he was on the show just over 2 years ago. What's more, it's looking to more than double again in the medium term. Tanguy Touffut, CEO and co-founder of Descartes Underwriting, is one of the indispensable leaders in the burgeoning parametric insurance sector. Descartes is probably the best funded and certainly the most ambitious of a cohort of peers to emerge in the last 5 years on the back of the insurtech boom. It's made a large strategic bet on the sector, building a global network of offices and now employing over 200, with more offices and hires still likely to come. Now that the sector is beginning to mature and the field of startups begins to thin out and parametric covers are joining the day-to-day toolkit of major brokers and commercial risk managers, it was great to catch up. Much has changed since we last spoke, not least a huge shift in the state of the reinsurance market and the emergence of artificial intelligence into the global psyche. So we had an awful lot to talk about. In an industry where conservatism and skepticism are not only endemic, but often valued character traits, Tanguy has a clear vision of how the right parametric solutions applied in the right places are going to transform insurance for the better, in consistency and transparency of pricing and coverage, as well as in speed of claims handling and payment. My job for large parts of this podcast was to play devil's advocate and challenge Tanguy on this new modus operandi of insurance and whether it is a genuinely disruptive challenge to the commercial insurance sector as a whole, or something of a passing fashion. Tanguy came through extremely convincingly. He may be a visionary, but he's also a realist who knows that if this relatively new method of risk transfer is to succeed long term, it must have a genuine technical edge over traditional indemnity insurance in terms of its understanding and pricing of risk. Hence Descartes' huge investment in scientific and technological talent. This is someone who's thought deeply about the whole insurance value chain and knows where it might be improved, and that's what makes this a fascinating conversation. Listen on for a grand tour of an exciting and fast-moving new insurance sector with one of its principal architects. Enjoy the podcast. Tanguy, welcome back to the Voice of Insurance.
Thank you, Mark. Happy to be with you today.
Yes, I can't believe it's been a couple of years already, and I'm sure in startup time, years go quicker than they do for old incumbent insurance companies. Time means different things to you, I think. I remember last time we were speaking, you were expecting to write about $50 million in GWP. Why don't we start with an update on where you are in terms of size and headcount? What does Descartes today look like?
Yeah, we talked 2 years ago for the last time. So we have managed to grow quite significantly. So we're only a half year now, but we expect to be above 200 million GWP, so at least, hopefully well above that number by the end of the year. So that's a big growth compared to the 50 million when we exchanged last time. In terms of headcounts, so now we have actually 8 offices in the USA, 4 offices in Europe, and 4 offices in APAC. So we have a very dense footprint across the world, and we have more than 200 employees, so 200 FTEs. So it's quite a nice increase.
So do you feel that with all that footprint, that's a very big footprint, do you think, is that kind of you finished for the moment, or are you still expanding that footprint at the same sort of rate?
I think we'll keep on investing in the USA. So I think 8 offices is a good start, but we really need to be closer to brokers and clients. And it's relatively decentralized in the USA compared to Europe. Typically Europe having Lloyd's of London and the London market being very powerful and centralizing some corporate business. The USA is different. We're also in LATAM. So we are planning to open an office in Mexico to cover both LATAM and the domestic markets. Today, we have an office in Madrid doing that, but we think that there is enough potential to justify more investments in LATAM. And I think in Asia, we are good for now, having Singapore for Southeast Asia, Hong Kong for China, and Sydney to cover New Zealand and Australia, plus Tokyo in Japan. I think we have the right coverage to address the Asian markets.
That footprint, it seems very interesting because I suppose we're talking about something that's sort of an ultra-modern new idea of insurance, a new version of insurance for many people, but it's still that proximity. Do you feel that you need that proximity to those brokers, to those clients? It's funny, it almost seems, because everything is technological or on the internet, that you might want to centralize everything globally somewhere. But it seems interesting that you need to be close to people physically.
people think about tech as a way to sell goods on the internet.
Yeah.
I think in the insurance industry, in the corporate segment for large corporations, you can disrupt the entire value chain except distribution. I think the end clients are looking for brokers to support them. I don't think it will change anytime soon. So typically our true clients are brokers, and we need to be close to them, be it in Little Rock in Arkansas or in Singapore. We need to be close to them. Otherwise, they won't think about Descartes as a potential provider.
So as you've got 4 times bigger in the last couple of years, we're always iterating plans. Your original plans change when they meet with different circumstances or new realities. Has anything changed in the way that you go about your business, your strategy, since we last spoke?
No surprise, there are more tensions across the world. So there are some geographies where we do not expect to invest that much. Definitely, Russia is out of the question right now. Same for Ukraine. I think there are new ways to leverage AI. So people talk a lot about AI. It's a very large and broad idea. It encompasses different methods to leverage new techniques. And it has also implications in the way we code at Descartes. So we're trying to both improve the quality of the codes and also the time we require to code. So clearly there are new applications, not only to design new products. It was more the case for example, computer vision or neural networks. It was more a way to use satellite imagery to build innovative products to cover, for example, wildfires in Australia. In that case, it's more about efficiency and how to process new data sets. So it's clearly something that we are using. 2 years ago, the technology, of course, was not ripe enough to be leveraged. Now we start having a very interesting applications, and I think it's only the beginning. Of course, there is some excitement. When people are too excited, they get disappointed, and I expect some disappointment in the near term. But I'm pretty sure it's going to be something huge in the next 5 to 10 years, maybe 5 to 15 years.
So it's saving you a lot of effort. I mean, how much efficiency are you getting out of this in terms of productivity? Because I presume a huge amount of your work, of what your underwriters and all those support staff, the analysts in your business, they're trying to create indices out of data. And it sounds like the ideal application. So is that the main application that you're doing, that these tools are going to be allowing those teams around the world to be more productive?
It's one of the applications. There are others. For some lines of business, you can better assess the risk thanks to Gen AI. But if we look at efficiency, we also have to be careful because depending on the profiles that may use AI, the gains could be quite different. And it may change over time. So what I say today may be wrong in 2 years' time or 5 years' time. So I have to be very humble about that. But clearly for senior software engineers, we can expect quite significant increase in productivity. Yep. For junior staff, it could be different and it could be misleading. So typically, I think it's also what we can observe for students at school. We have to be careful not letting them use that and replacing their brain. Actually reach the wrong conclusions. So at this stage, at least it's more a powerful tool for senior people than for, I would say, junior people. But again, it may change in the near term. It's moving very fast.
Somebody described using Gen AI as like having a very smart PhD intern who never gets tired, obviously, and never goes home and works 24 hours a day. And is that why it's more valuable to a senior practitioner than it is to a junior one?
If I use a metaphor, it's a kind of a compression of lots of data, lots of knowledge across the world. So it's really the way to understand it. If you don't have like the ability to read and write, this knowledge won't work. To start with the basic knowledge first, be able to take a step back and analyze the data. Otherwise, more data won't make any difference. I'm not sure that the metaphor will be understood by everybody, but clearly it's a new tool. We have to understand what it means, the bias also. There is a huge one, and how to make the most of it. For someone not being able to read and write, of course, it's a bit too early to use such a tool.
You really need that ability to interpret what it's saying and to see when it doesn't make any sense and when it does make a lot of sense.
Yeah.
You need that insurance experience, I suppose.
If the sense actually is definitely aligned with what our intuitions would say. Also, it's a good way to start. If it's something that is completely surprising, maybe it's true, but maybe it's for other reasons.
So giving one of these tools to the junior is a bit like, I don't know, giving them a chainsaw when in fact they should probably have a pair of secretaires or something small.
Exactly. But I mean, my view at this stage, I would say the investments in the industry are huge. I think we will see probably many new applications in the next 2-3 years. I would say some of the companies are really working to make such tools available to everybody. So not only, I would say, people having a relatively advanced knowledge.
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started. And are you doing a lot of this on a proprietary basis, or it seems like there's so much investment out there that there are so many tools that are being created for you to use? Are you more a user?
Again, it depends on the technology. We want to have all our models in-house. This is something that is crucial. One of our key convictions is that if you're an insurer or an MGA, your model should be in-house. There should be no black box. You need to feel comfortable with both your data, your algorithms, to make sure that you can offer a fair price to brokers and clients. Otherwise, you should do a different job. So we want to keep everything in-house. But typically, if we talk about Gen AI, we're talking about companies having invested billions and billions, and we won't be able to do that. So in that case, it's more a tool that will be on top of our in-house tools to be able to make them better. So it's more incremental in that case. Because again, we will need to raise potentially several billions to start building our own technology. It's not the plan. We prefer to use, I would say, existing tools or methods.
Well, we might as well ask about funding as well, because when we last spoke, tech funding in general, and insurtech funding specifically, probably was a warmer temperature than it is currently. Has that affected the speed at which you can develop Descartes?
Not really. In our case, we are quite lucky because we tend to be very conservative also in the way we invest and spend money. So we are not at all under pressure to raise. We can keep on investing for many, many, many years. So it's a very comfortable position. It also helps us to potentially consider some acquisitions if we find any, but we are not under pressure to raise. That being said, I think most funds raised also tons of capital 2 years ago, 3 years ago, and they will have to deploy this capital to be able to raise more funds in the middle term. So I don't expect the valuations potentially to come back to the levels that we observed in 2021. But at the same time, I expect the sound companies that have like good financials to be able to raise in relatively good conditions in the near term. So I expect typically more raises in the next 6 months, 12 months, both in the US, in Europe, and in Asia. So I think if you have a sound business, you will always find investors willing to support your growth and make sure that you'll be able to reach the profitability milestone that is key in any industry.
So to summarize that, you went quite large and you went quite early for the funding. So you've got the luxury of having that capital money in the bank, is what you're saying, really.
Definitely. Well, we had one of the largest Series B in the insurance industry. So it gives us plenty of time to execute. I think something that could be painful when you start a new company is some players have to raise every 18 months or 2 years. Of course, it takes lots of time. It's not management distraction because it's key for the company to stay alive. But in our case, we just have to focus on execution, the new products we want to launch, the new geographies in which we want to have an office, for example. It's more about execution, so we are much more efficient in the time allocation.
And what you were saying about potential, I think there was a huge flowering of different parametric themed businesses in the last few years. You were hinting that perhaps there might be ability to consolidate some of those, or is it really about the talent that's actually behind those businesses? Is it the people that you'd be happier to consolidate, or rather than their business?
I mean, both cases are, I would say, on the table. It's public information, but you may know that OTT Risk disappeared.
Yeah.
So we recruited someone from OTT Risk, a very qualified senior executive in insurance. So we're happy to have him in the UK office. So clearly, I think the ecosystem is quite resilient. And if there are like good profiles willing to join us, of course, we will be willing to open the doors and onboard them in the company.
Well, I suppose the other really big thing that's happened, well, lots of things happened in the last 2 years, but Because the most significant one would be that the property cat reinsurance market hardened very significantly. Has this given you lots of new opportunities? Because we're opening up big gaps in reinsurance programs, big gaps in coverage in different places. And of course, those gaps and pressures being passed all the way along the chain. Has it been good for you in terms of really waking up some of those customers and brokers to saying, right, we really need an alternative now because traditional reinsurance is not necessarily delivering all that we used to get off them?
To be transparent with you, I think our model is quite resilient, whatever the cycle. I think if it's a soft market, we have the right model. If it's a hard market, we may have to adjust a bit the way we price and our targets. But overall, for us, it doesn't make such a big difference. It's true that for large corporations, when they get squeezed, they may look for innovation, whereas in a soft market, they may decide just to renew with their existing insurer. That's clearly a risk. But overall, we see that many large corporations now are switching to parametric, sometimes to replace the existing property coverage, sometimes to add something on top of the existing program. So I think there is a very positive trend about parametric insurance and more applications. I would say 10 years ago or 15 years ago, it was mainly quake and hurricane. Now we are seeing lots of hail, lack of solar additions, flood, drought, lack of wind energy content for wind farms. So looks much more diverse, and clients are willing to buy some parametric products for applications that were completely unknown even 3 years ago. So this is something that we observe. Maybe it's related to the hard market, especially in the USA. I mean, one of the outcome of COVID-19 was the inflation in terms of exclusions in many contracts. So insurers have tried to protect themselves as usual. I mean, it's how the industry is built. So we burn our fingers. We add some exclusions to avoid history repeating, which is, I would say, not unusual and not a bad thing in the end for the industry. But for the end clients, it's true that facing an inflation in terms of clauses and in terms of the rates is disturbing, and they're offering like very simple wordings with no exclusions makes a huge difference. Whatever the price, there is something that I would say opens a dialogue with brokers and risk managers, especially in countries where there may be lots of litigations.
Yeah.
We know our industry is unfortunately full of litigations.
Yes, it is just a fact of life that I suppose no insurer ever goes to design a product by first thinking of the exclusions. They tend to think of the operating clause to say, I will insure you for these things or for your activities. And I suppose, exclusions have always come in through experience. So things that we hadn't thought of, etc. A parametric policy pre-COVID was hotel occupation, for example. And I suppose something like that kind of experience, I suppose the exclusion is you just don't really want to write hotel occupation on an index because, of course, the previous data would have told you that it oscillates, and you might have had terrorist-related downtimes, or we had the first Gulf War certainly would have affected transatlantic hotel occupancy, and then the second, and then obviously 9/11 and other things. You could see that in the data. But then you come to something like the pandemic and you think, oh, goodness, I hadn't thought of that. So that was a parametric product within the sort of Lloyd's product innovation facility. But I think something that clearly didn't work.
We know that underwriters tend to forget previous events. If we look at pandemics, we had similar events 50 years ago, 100 years ago. So it was not something completely new. We felt a bit more like invulnerable as human beings. We discovered that it was not true, unfortunately, and many people actually died. But if we look at the last 300 years, we have similar events, and this could have been completely understood and taken into account into many models. Just the frequency may be up for debate, but otherwise it's something that could be relatively well modeled.
It's interesting you were saying that you would have some clients who were actually using parametric to replace their traditional indemnity cover. Is that a common trait? Normally, would you agree that parametric insurance is most likely to be viewed as a complementary cover rather than a disruptive one that's going to replace the previous cover?
As you can imagine, I'm more tech-driven than the usual insurance company. So I really believe that we'll be able to use more data, build more algorithms to design better products. And in some cases, for some parametric products, there will be no basis risk. compared to traditional insurance covers that will have decent share of basis risk. For example, if we look at wildfire or bushfire in Australia, if you use satellite imagery, if you use the computer vision to be able to detect, for example, the rivers, the roads, the natural forests, so you're able to really understand the exact location of your client's asset. And at the same time, through satellite imagery, you're able to detect if it's burnt or not burnt. If you send loss adjusters on the ground, even if you send, for example, 50 of them, in the end, the ability to capture through computer vision and algorithms, the true loss is much better than through the work of experts. It's not true for all products and for all lines of business, but in some cases, we're in a situation where we're able to beat traditional covers, and in that case, replace them with a lower basis risk and a fair price, because we'll be able to really have no buffer. You know how insurers work. If they can't really have all the data they need to price, they have some buffer on top to feel safe. If you can get rid of the uncertainty, then you can get rid of the buffer. And then your price is in the end much fairer than through, I would say, the old approach.
But in terms of the structure, could not a traditional indemnity insurer use the same techniques and technology that you're using? And I'm sure some of them are using that to replace some of their adjustment and surveying assessment, risk assessment. But does that mean that you need a parametric structure? Or could parametric, some of the technologies and the structuring and the knowledge and that wisdom that you are now applying to the business, could it be sitting in the background rather than necessarily be in the front?
If you use the same technology and in the end you still have to send loss adjusters on the ground to assess the damage, just the economics won't be the same. So you just have to ask your clients.
No, but if you did the adjusting via satellite, for example.
Yeah, exactly. In that case, if you have like everything through satellite imagery, then it's parametric in the end, because it's just you multiply. You can call it indemnity, but it's going to be parametric because you have the parameters. You know how much you should pay per hectare, for example, in each location. So it's a simple multiplication. It's parametric. As I said 2 years ago during our previous interview, for me, parametric insurance is a means, not an end. So basically, as long as our clients get a fair price, as long as we can pay them very quickly, as long as it's transparent, so we won't say, oh, by the way, for example, for plantations, if you look at British Columbia, many people were actually not covered because there were plenty of wildfires. So they applied deductibles to each wildfire. In our case, in our solutions, we won't consider multiple events. We will just look if it's burnt or not burnt. We won't say, oh, actually, there were 20 wildfires, so we have to apply 20 deductibles. So clearly, in one case, the client would be delighted and it's very quick. In the other hand, it would be a big litigation, and in the end, the insurer will win because it's quite standard to have deductibles per event in our sector.
No, it sounds like a classic lawyer problem, isn't it? How many events is a wildfire? It was one wildfire on the news, but of course it was 20 different fires, or sometimes an aggregation of different fires with different sparks.
We just say it's burnt or not burnt. Then, of course, the client can decide if we start paying after 5%, 10%, 15%, because the price is not the same if you cover like the very small wildfire or something huge. But otherwise, we don't have to justify the number of events that we will apply to the cover.
But you're sitting with a very traditional risk manager and their broker who's saying, you know what I really want? I just want my insurance just to pay out. And I don't want to have to worry about whether there's basis risk or all these other things. I don't want to have something too complicated. Do you think under those kind of scenarios that they have a wording that's very similar, but whereas it's using parametric techniques behind the scenes rather than at the front end of the policy?
It could work upfront or I would say at the back. We work with clients on different solutions. I think when we say indemnity, again, people should fully understand the meaning of all the exclusions. I've been working in industry for more than 20 years. Sometimes, honestly, when I read the insurance contracts, I have no clue. And I think only very gifted lawyers can imagine all the potential scenarios and the way to interpret the clauses. So I don't think that having a traditional insurance wording would make a risk manager really safe. What is true is that for most parametric insurance products, we also explain clearly what we don't want to insure and what is not actually covered. So typically, sometimes there could be a scenario leading to a scenario, leading to a scenario, something that, of course, is not at all the spirit of the policy. And with the parametric wording being very simple, we also explain clearly what is not covered. So what is covered, but also what is not.
Is it fair to say that yours is a particularly affirmative type of insurance? It's saying, we are covering you for this thing.
Exactly. We cover flood. So it means that if you want like a quake policy, we have to go for a quake policy. Same if you cover cyber, it means that we won't cover potentially a fire in your factory. So we have to be really clear about what is the intention of the contract.
Going back to something like property cat, which I'm sure you'd have had a lot of opportunity in, particularly because of the market opportunity, because the perception of that risk has changed. But so obviously the perception of that risk has changed because of bad experience, because of lots of losses accumulating. Do you have better skill, as I suppose is the way I'm about to ask you? Do you think you've got better skill of finding, presumably the demand is lower down, nearer to where the losses are going to occur, and you've already hinted that your kind of cover, there are less buffers, you want to get much closer to the risk, and obviously something that which that risk manager, that client is going to be much happier with, because yes, you won't have accumulations of different deductibles and different sublimits and all these things. But if that risk is generally worse, do you think you can find something that's going to be economically viable? Or do you have to then be the bearer of the truth, if there is a truth, to say, you know what, this really isn't insurable on economic terms, because genuinely this risk is worse. It has got worse. The climate has changed, or whatever you want to say. There are more droughts and there are more wildfires. And yes, because of the climate has changed, the risk has changed. Do you think there are enough opportunities in this new land that has opened up in between the traditional insurers and reinsurers who want to be higher up away from that risk? Do you have enough profitable territory where you can operate? Because the question is the risk really that bad?
It's a very good question. So to make it short, it's true that we don't want to hide behind exclusions and we don't want to use a buffer. It means we have to be much better in the way we understand the risk.
Yeah.
So typically for natural perils, we have now the largest team in the insurance industry in terms of number of modelers and software engineers, just to understand, for example, hailstorms, just to understand wildfires, understand floods. So basically, we need to use physics to make sure that we understand not only the historical events and try to detrend them. We must basically use all the factors leading, for example, to a flood, to a hailstorm. So the physical aspects that will lead, for example, to a wildfire. It could be soil moisture, it could be wind shear, it could be temperature, and model the potential event. So it's a completely different approach. So we're not talking about statistics, but really physics. It requires lots of data sets. You can't use Excel, you have to use Python. So it's a different model. That's why we are a tech company to be able to achieve that. And then the second part of the question is about then are we able to find, despite climate change, some brokers and clients willing to buy a cover? Of course they do. In some cases, it's easier after a big event to convince risk managers and brokers that actually they need to be protected. If we take an example in the Nordics, it's quite similar to British Columbia in terms of the weather conditions. Prior to the big events in British Columbia, nobody said that actually there could be such huge wildfires in Canada. Right now, we are working hard to protect some clients in Canada, typically on the exposure to wildfires in British Columbia, because they really understood that it's not science fiction, climate change is real. In the Nordics, there was no major event yet. So it's true, it's more difficult to explain to clients and brokers that actually they have been lucky so far. And that unfortunately, if we look at the drivers behind the wildfire, actually, it's quite unusual that they have not faced anything big so far. But as soon as the event happens, then because it was well modeled in our rates, we won't have to exit the market or to ask for a price increase that will be 20 times the previous rate. So we are much more stable. But it's true that in some geographies, there might be a mismatch between clients saying, I have not experienced any flood over the last 30 years, and us saying, well, yeah, maybe, but it's a miracle. If we look at the weather conditions, we can expect something huge to happen in the near term or the middle term. So yes, we have to sometimes to convince our clients about the reality of climate change. The issue with climate change is that it's not even exponential. In some cases, there are some locations that were protected from natural catastrophes that will face actually catastrophes. Even if you have like no data points in history, it's difficult to apply any trend. So it is something that is very hard to explain to some clients. But after an event, and unfortunately there are plenty of examples, we have faced more than 100 billion losses for the fifth consecutive year in the insurance industry for Nat Cat. And I know that this year looks bad too. So I would be surprised if we don't reach that number, even if the hurricane season has not started yet. It has officially started 3 weeks ago, but so far so good.
But you think there's enough space there for you to find those pockets where you think there are economical terms to be had? As you were saying, you were kind of alluding to markets where you're probably priced out of the market as it is today because it hasn't had a loss yet, and others where, of course, you're very much being given the opportunity, but you have to decide whether you want to drink that cup, whether you think it's poisonous or not, but you already have a clear view. It sounds like you have lots of opportunity, or you're also expecting to get more opportunity.
Yeah, definitely. And typically, sometimes, insurers after a loss, they may tend to overreact. So they say, okay, the price should be 3 times or 4 times or 5 times more. Sometimes it should be 10 times more. Sometimes it should be just 1.5 times more. So in our case, we may actually be much more affordable than many competitors because of that. It's not true for all geographies and all perils, but we tend again not to overreact. There is no panic button within the company.
I should ask you about the structure of Descartes these days. You've got a balance sheet insurer. What's your intention? And now, more years into this world, what do you want to be? Do you want to be that full stack insurer and obviously still having all those relationships with reinsurers? How would you like the structure to be? Obviously, you're still an MGA at the same time.
Yeah, we have different vehicles. So we are both an MGA and a risk carrier, having our own vehicle fully licensed in the European Economic Area. So this is clearly a very great asset. In our case, climate change is huge. It's going to be bigger and bigger. So we need to partner with the ecosystem. So we need to partner with insurers, reinsurers, asset managers, so the ILS world, to be able to get enough capital. We need, of course, to work with brokers to design the covers, to be able to reach out to clients. So for us, we are just part of something much bigger. And we are really between, I would say, huge balance sheets and basically brokers looking for solutions for their clients. That's the way we see us, being able to innovate in terms of new products and also being able to better price than the incumbents.
And that rationale of having your own balance sheet doesn't sound like you have that ambition to be the steward of that capital, be the effective owner of that capital. Sometimes it's the way you have to do it.
For many of our risk carriers, having some skin in the game is very important.
Yeah.
You tell them that basically, if there is a loss, you will feel the pain. I think this is something that could always be an issue with MGAs. There may be a lack of alignment. In our case, we know that we cannot grow if we're not able to provide satisfactory returns to everybody in the value chain. So we are very careful making sure that we underwrite fair conditions. And having a carrier is a good example of the fact that we are delivering and we are taking that very seriously as if we were actually themselves. So taking care of their balance sheet.
Obviously, that's EEA. Might you be interested in having more global licenses? Obviously, many vehicles are available to you to help do that.
Today, we are active, for example, in Spain, in Belgium, in the Netherlands, in Germany, so apart from France. At this stage, we are not considering other geographies. I think Europe is already a significant market. And we have our MGA model that has a global reach. So we don't really need to complexify too much our model. What is true is that if you want to be like an insurer worldwide, it's a different game in terms of all the regulations that should be applicable, all the licenses you should be able to keep updated. So it would be a huge investment in terms of the operations. So we want to remain as simple as we can, despite our sector being highly regulated for good reasons. On top of that, we know that insureds need to be protected and they need to get, again, a claim payment in case of a potential loss. So it's completely fair, but we need to be lean despite requiring a global scale. I think we have a good compromise today.
Recently, you've launched, you're one of a very small number of players that are doing parametric cyber insurance. How's that going? And any other classes that you're looking to get into? You've already mentioned quite a few with lack of wind, lack of sun, other things. Anyway, how's it going with the cyber and any other classes you're looking to go into?
Yeah, so today we actually cover all natural perils. So we have more than 25 perils that are covered in the climate/natural space. Cyber is something quite different, quite new. I think it was required by our brokers and clients. We know that the cyber market is not mature yet. The products are quite similar. They have been built over the last 20 years, and sometimes it was, I would say, a test and learn approach. We have not suffered from too many big events yet, but we all know that it's coming. So we wanted to have something quite unique in terms of products with different carriers and more to cross-sell actually our existing brokers and clients. So it's more like when you operate in the corporate segment, cross-selling is a key way to grow. And we are actually selling cyber now to our existing clients, and we will sell also other products. It's a bit early, I would say, to explain our next moves, but be sure that we have a R&D team that is working on other products across other lines of business. Usually it takes us at least 18 months of R&D to really identify all the data sources that are not fully used by the market, to build the algorithms that makes us robust in terms of our understanding of the risk. So it's not something that we can launch in 1 week because of this modeling exercise. And for cyber, typically it took us some time to be able to feel smarter than the market.
And that would mark the first risk that is not something that is to do with physics, I suppose.
Exactly.
So should we expect to see more non-physics related risks, i.e., not natural world risks?
Yes, and typically we think that Gen AI could be used for some lines of business. Typically, we were used to leverage lots of satellite imagery, remote sensors, radars, sonar, so many different tools related to measuring weather and climate. Gen AI is a new source of inspiration for us, and we see that the incumbents are not really using that for pricing at this stage. So we want to be pioneers, so we are working on that.
We had an update on where you are now compared to where you were a couple of years ago. Where do you think you'd be in 2 years' time, and then maybe 5 years' time or 10 years' time when we're talking on episode 1000 or whatever of The Voice of Insurance?
In the middle term, we want to reach 500 million in terms of premiums. So we'll be above 200 million this year. So it means we have to multiply by 2.5 the top line. At the same time, we want to be disciplined. I know it's a word that is used every day in our sector, but it's important to grow in a resilient way. So we don't want to have a growth rate of 80% and then discover that actually our loss ratio is not good enough to be able to sustain our growth. If we have to take 2 years, 3 years, 4 years, 5 years, doesn't make any difference to me. We want to grow at the right pace to be able to be actually still around in the next 10, 15, 20, 25 years, again, to be able to be part of your next episode.
Obviously, insurance has a reputation for being conservative, but probably that is generally has been a good thing about insurance. Obviously, new things in general have been the things that bring the new problems with them. So do you feel that sometimes because you're new, that you're slightly on probation from some of these people, that therefore you do have to be slightly more conservative in terms of your pricing, your own view of risk?
Most of the senior management at Descartes comes from the insurance industry, mainly insurers, reinsurers, and sometimes brokers. So we speak the same language. We know, again, how to build a good portfolio, knowing that customer satisfaction is key, but also the reinsurance industry should make profits. Otherwise, they won't support the growth of the industry. So we are aware of the equation and how we have to make it work, which is difficult. It's very easy to grow in the insurance industry if you're not disciplined. So this is not our spirit or our DNA. So being part of the insurance family helped a lot at the beginning. At the same time, we are, I would say, a hybrid company. So we have lots of tech profiles. So we are trying to make the most between the conservative insurance industry with lots of knowledge and wisdom, and at the same time, tech people being able to challenge a bit the status quo, being able to look at guidelines, models in a different way. to be able not to break all rules, but just break a few rules that actually don't make any sense.
Mm-hmm.
I think in the industry, sometimes we are following conventions. Sometimes we have good reasons to follow such conventions. In some other cases, it was actually valid a century ago, but today we have other ways to challenge that, and we should do that.
And I suppose already at a $200 million base with many different perils, you're already quite well diversified, and of course diversified hugely by geography as well. But it sounds like you're diversified away from the potential that you may have had a miscalculation in one of your classes, for example, and you suddenly realize, oh goodness, we have made a mistake.
Yeah, we have to be very humble in our industry. You can have like the best brains, the best PhDs in the market. We may always have surprises. I think many big reinsurers recently made announcements saying that actually they screwed up and they completely missed the consequences of climate change. This is something that was part of our story at the beginning. I know that most new companies, they tend to reach some scale locally, so in their domestic market. And after 5 years, they try to grow in the market nearby. So for us, it would have been Germany, Belgium, or Spain. And we decided from day one to invest in Asia, to invest in LATAM, to invest in the USA. It was also a way for us to be more diversified and be able to be much more resilient. For example, like a big issue about precipitations in Colombia, if the rest of the world is fine, it's going to be fine. If at the same time there's a major bushfire in Australia, it's going to be the same story. So we need a bit of everything in the end to feel completely safe. That's why we have 25 different insurance products between a tornado, typically low river height, excess of wind, lack of wind. So this is something that protects our business in the long run.
Be really looking forward to speaking to you again in a couple of years' time, Tanguy, and see where you've managed to get to and see what you've learned, because we can certainly see that the world seems to be getting more uncertain rather than less. And I'm sure that we'll be able to agree on that in the next couple of years. And we'll see how far you've managed to get to penetrate further into the psyche of the brokers and the big risk managers, I think. So thanks very much for being on the show, Tanguy. I've really enjoyed it.
Great. Thank you, Mark, for your time.
No, thank you very much.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.